Hello, everyone. How are you doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to get everyone an update on credit card debt. If you recall, a few weeks ago, I did basically a credit card debt episode where I just talked about what was going on with credit card debt, how we had gone over $2 trillion currently in credit card debt, and how that was becoming an increasingly larger problem for U.S. consumers. So I just wanted to share with everyone a couple of articles today. So the first one we're coming up on here, this is from S&P Capital Intelligence, and this article is called Average Net Loss Rate for U.S. Credit Card Issuers Hits Highest Level Since 2020. So now let's look at a couple of charts here. I just want to read something for everybody real quick. So the average annualized net charge-off rate for the six major U.S. credit card issuers rose 15 basis points in December 2023 to its highest level in more than 2 years, according to S&P Global Market Intelligence Analysis. 5 of the 6 companies in the analysis logged higher net loss rates sequentially. So in other words, that's a fancy way of saying that basically delinquency is going up and that we're getting very close to hitting where we were pre-pandemic. And we're going in there. So we could see from the chart here. So for the podcast audience, we're looking at a chart right here of the 6 major credit card companies in the U.S., which is American Express, Capital One, Discover Financial, Bank of America, Citigroup, and JP Morgan Chase. So you can see here, we have a chart here of basically the year 2023. And we can see here, we actually have, it also has December of 2022. So you can kind of match like December to December of each year. And you can see from December of 22 to December of 2023, we have really, we've seen a pretty, good size increase there. Now, what is a little deceptive here is that it says, oh, well, it increased 15 basis points. Well, that's, banker parlays for like, yes, there was an increase, but how do you really interpret that 15 basis points? Well, the 15 basis points is kind of significant considering the fact that you were going in, I think it is, it looks like American Express here was at 0.73 as of December 2022, and now they're up to 1.49. So that's a pretty significant increase there. I mean, that's basically doubled since last year. So, and let's go down here. We have another, but I just wanted to say, so delinquency nears pre-pandemic high. So the average 30-plus day credit card delinquency rate for the 6 credit card issuers was fairly flat, rising only 1 basis point month over month to 1.36% in December 2023, the highest since it stood at 1.46% in May of 2020. So Capital One recorded the highest delinquency rate among the 6 issuers at 1.94%. It posted a 6 basis point sequential increase and a 69 basis point increase year over year. Discover's delinquency rate ticked up about 5 basis points to 1.59%, while Citigroup and American Express logged 2 basis point declines in their delinquency rates during the month to 1.45 and 0.77 respectively. So we can see here that basically delinquency rate at these credit card companies is continuing to rise. And now I'm showing you this because we're going to go into our second article here. So this is an article from the Wall Street Journal. This was just on January 24th, so just 4 days ago. And this was credit card debt is up and it's taking longer to pay down. Customers of the biggest U.S. banks have steadily increased unpaid balances. So in other words, balances are going up and they're staying there, and people are not paying their credit card balances off. And that is basically a bad sign. So let me just read a couple highlights to you here from this article. So the 4 biggest U.S. banks reported higher credit card spending in 2023 compared with the previous year. In fact, since 2020, credit card spending has steadily increased at 3 of the 4 banks in question. The exception is where credit card spending hit a recent peak in 2021. At the nation's largest bank, credit card spending was up 9% in 2023 to $1.2 trillion. Spending was up 15%, at which spending was up 15%. Delinquency rates have also been on a steady rise since 2021. Customers aren't paying off their charges as quickly as they used to. Credit card loans or unpaid balances on accounts jumped 14% at JP Morgan compared with a year earlier and 9% or at 9% in the previous year. So credit card loans were also up at Citigroup and Wells Fargo. In aggregate, credit card loans at the four banks grew faster than spending grew in 2022. In theory, this is good for the banks that charge interest on consumers who carry a balance, but rising credit card balances could be a sign of worsening financial pain for consumers and the economy. Consumers have been spending more than they're taking in. Consumer deposits at the four banks declined in 2023. At JP Morgan, deposits in consumer banking unit were down 3%, while deposits in Citigroup's U.S. consumer banking arm fell 8%. Consumer deposits fell 8% at Bank of America and 9% at Wells Fargo. So in context, what is this telling us? This is telling us that delinquency rate on credit cards are going up. People are not paying off their credit card balances. They're not able to pay off their credit card balances, and deposits are going down. Meaning, and if we looked at a chart of the consumer savings rate, we could see that the savings rate was going down, in unison with this. So the deposits are going out, the savings rate is going down. So in other words, what is happening? The consumer has depleted their savings. They're now living off their credit cards, because let's look at the reasoning behind this. Like, why are people spending more on their credit cards? They're spending more because of the inflation. The inflation is killing them. And you've seen basically inflation on most products is up anywhere from 20 to 30% over the last 2 years. And that inflation is continuing to hurt them. And so as a result of this, what you're going to see is the credit card delinquency rates are going to continue to go up. I would imagine at probably some point before the end of the year, the 6 major credit card companies that we mentioned will probably all dramatically start to slow down the availability of credit cards that they're going to give to people out there. They're probably going to make it harder to apply for credit cards. They're probably not going to as quickly extend credit as they had been previously. And it's something that we'll just have to keep an eye on, but it's a bad omen. And when you add up what's going on with like auto loans, mortgages, and then student loan debts right now, it all adds up together into basically that means the consumer is not in a great spot right now. So, but I saw this and I thought it was important because the article basically specifies what I was talking about, a month or so ago, and that is that this is something we have to keep an eye on. Consumer credit card debt is a very important metric to look at in terms of what's going on with the consumer in the overall economy. Now, like the article said, hey, this is great. Consumers keeping big balances, pays a lot of interest to the banks. The banks make a lot of profit off of it. That should be good. In theory, yes, that is good. But in actual reality, it's not going to end up playing out good, because as delinquencies go up, that means people charge amounts to their credit card. Could be $5,000, $10,000, $50,000. But the bottom line is those are balances that are charged that are probably never going to get paid. And there's going to be interest on those that banks are not going to get paid. And they're going to lead to a lot of write-offs on a lot of debt, a lot of charge-offs. They're going to come. And, so this is going to potentially become a big problem for banks over the next couple of years. So, and you could see here, so we're looking at a chart here. This is credit card spending volume. You can see this is the big 4 banks: JP Morgan Chase, Citigroup, Bank of America, Wells Fargo. And you can see kind of where the credit card spending has been. So, 2020, it dipped. Why? Because a lot of people were at home, weren't really out doing a whole much for most part of that year. And then you can see 2021, 2022, 2023, you can see that credit card spending has just gone up and up and up the last 3 years. And that basically has coincided with the increase of inflation rolling with that as well. And then we come down to another chart here. We can see credit card loans, 30 plus days delinquency rates. And again, the big 4, Wells Fargo, B of A, JP Morgan, Citigroup. And you can see from the fourth quarter of 2021 where they kind of reached their bottom, and they've just been shooting right up ever since. And then we have credit card loan balances, in billions. You can see 2019, we kind of hit a peak, and then 2020 and 2021, it came down a little bit. And again, this is just looking at the big 4 banks. And right here, we're probably 2019, we're at, what does that say? It says 39.90, but that doesn't seem right, because it's about 450 billion right here, and then it kind of drops back down to about, wait, I'm sorry, I see what they're going here. So okay, I'm looking at the individual as opposed to the total. Sorry. So, so we got between the four banks, we've got about 475 billion in 2019. Then it probably drops down to about 425 in 2020, 2021. And then we bump back up to probably about 460. And now we're probably about 550 billion right now in 2023. So that's where we're at right now with credit card debt. This is something we're going to continue to keep an eye on. If you're out there, again, if you have a problem, if you're struggling with credit card debt, try to seek some type of consumer counseling. Contact credit card companies, see if maybe you can go on to some kind of payment plan in which you can just pay that thing off monthly over a specific period of time. See if maybe they'll be willing to lower your interest rate. Most credit card interest rates right now are probably in the neighborhood of anywhere from 22 to 27, maybe even 28% rates of interest out there. So if you can get them to cut you a break and maybe bring it down to 17 or 18% or something like that, I mean, every little thing is worth a try. So, but again, like I said, hopefully we'll just have to keep an eye on this and keep an eye out. So I'll definitely be back to everybody with more updates on this soon. So thanks a lot.